24.7% ROI in just 3 weeks. Today, I want to share with you a strategy that my students in my mentorship and I have been using over the last few weeks. And so far, in 3 weeks, we've generated $495 off of a maximum of $2,000 risk at any one given time for a total ROI of 24.75%. And these are very safe trades. I'm not talking anything risky. We're not buying options. We're not doing anything crazy. So this particular strategy I'm talking about is spreads on the SPY, credit spreads on the SPY. Now, technically, when I put them all together, we end up with an iron condor. What I want to show you today, though, is why I don't like iron condors usually as just one trade, how I manage to get the best of both worlds while still being able to reduce the amount of collateral that I have in these trades at any one given time, right? So as you can see here, I had 4 contracts for February the 27th, but at most I've only ever had $2,000 worth of open risk. The reason being is because I've got 2 sides of the trade open, the put side and the call side. Now, what you'll notice as well is that date entered, the put was February 14, the call was February 18. So I like to look at the charts and go, okay, is today a good day to open a put spread? Is today a good day to open a call spread? And when the day is right, I enter the trade. I don't care about delta. I don't care about 30 or 45 DTE, particularly at the moment, right? I've actually been preferring 1 to 2 weeks DTE with the goal being to get out sooner. 45 days, 30 days in a market like today, like what we're in now, I find that it's actually harder to get out sooner. And yes, you've got more time to be right, but with the market trading down, it's more time to be wrong as well. And I don't want more time to be wrong. I just want my trades to be done like that. So come on into the chart with me. I want to show you when I enter each side, and then I want to take you into option strat to show you something really important, and that is the risk you have in the trade. Because I can hear people say already, and people say it to me all the time. If you've ever watched a video on credit spreads, if you've ever read comments, you're risking $1,000 to make $100. That's a terrible return. And I would agree if the risk was equal. If it was a flip of a coin, 50-50, terrible ROI, right? But the way that we do credit spreads, it's not a 50-50. You have got a much higher chance of winning your $100 than you do of losing your $1,000. And I want to show you how you should never be losing the full width of a spread. That just should not happen. So let's come on into the SPY and let's look at when we place the trades and where we place the trades, okay? So firstly, the put side of the trade. So to enter the put spread, all I'm looking for is when are we bouncing off of a level of support. So throughout these days here, we're looking like we're bouncing off of levels of support kind of through here, down here, right? When the next likely move is up, when we're trading at the lower end of the range, they're the days to enter the put spread. Put spread, very simply, just means we're saying that we do not want the price to go below our level that we choose, okay? So our sold put is what sets that level. How do I choose where to place it if I don't care about delta? I'm looking for something, give or take, about a 10% return, as long as my sold strike is below where I expect the level of support to be. So for example, I expect that this 150 EMA will provide a level of support So I'm making sure that I have my sold puts lower than that. Vice versa on the call side. So on the call side, we're entering these trades when we expect that the next likely move is down. So I'm not entering a call spread on a day like this because the next likely move is probably up. I'm entering call spreads on days like this. I'm entering call spreads even on a day like today, right? What am I looking for? Where am I placing this level? Above where I expect resistance. And again, at that give or take 10-ish% return. Now, I placed both sides of a trade today, the put and the call, for next week. So come and take a look at these trades with me. Actually, firstly, why did I do it? Realistically, because I looked at today and I was like, you know what? It's probably a toss of a coin what we do Monday. And I know like it is that, right? Like that's what trading is. 50%, well, not even 50% chance, but like they're the only two options. We go up a bit, we go down a bit. That's it. But oftentimes, the next most likely move, you kind of can guess, right? We're bouncing up against this resistance level, we're probably going to come down. We're bouncing off of these support levels, we're probably going to go up. But a day like this, it's really flip of a coin. So because of that, I was actually comfortable placing both sides of the trade and effectively opening an actual iron condor rather than just one or the other. So let's talk about firstly the bear call spread. Now the bear call spread, I don't have open to the full width of my trade, right? So my bull put spread is $1,000 in margin, $10 wide spread. The reason why I've left my call spread a bit more, like condensed, a shorter margin, is purely because when I go up higher, I'm not getting much extra for it, right? So I've gone for the 692, 700, but the reason why I like to do that as well is if I ever choose to roll this spread, I actually have some built-in room to do that already because I haven't used the full width of the 1,000, okay? That's something that's a bit more in-depth, and I go through in my mentorship, do we roll, how we roll, when we roll, do we take a loss, all of that sort of stuff. But for now, just notice that you don't have to use the full width of the spread if it makes no difference. Why would I risk another $100 just to get an extra, literally $3? So to me, that didn't make sense. Now, what can we tell by this chart? So we closed at 672 today. These are the dates, right? So come Monday, if we open Monday and we are literally at the same level, 673, my contract will already be in profit by $50 odd. If we come down to 670, so we drop by just 0.4%, then I'll be at about $70 profit. And if I get either of these profit levels within a day, you better believe I'm closing that trade and I'm out of there. Now, sometimes I set take profit orders. I actually don't have a take profit order set on this spread. I've been leaving my calls open to let them run a little bit more, at least for the first day or two, because we've got more downward momentum than upward. So I've been letting the calls kind of ride. But if in a day or two I haven't had an upward move, then yes, I will put my stop order in, my close order, somewhere between 50 and 60% profit. Now, how do we make sure that we're never receiving our full loss? You choose when you exit. That's it, right? So if the opposite happens, and on Monday, let's say we bounce up to this 685 level and I'm at a loss of at $120, I can choose to close that. And then I'm never at risk of losing $800. So if the trade goes against you from day one, 685 we bounce up to, I'm at $120 loss. I can take that loss. And I think that's the key that most people miss, is that they don't take small losses. Instead, they wait and hope and pray not to get the big loss. But choose your loss. Choose it. If you want a 1-to-1 ratio, put a stop at $93.50 when you're negative, right? The other thing that I like to do is if I hit my, in this case, my bought, so my 692, my don't go above level, if I hit that at any point in the trade, I'm out. If I want to play it really conservatively, take the loss, make it up on another trade, right? You can roll, like I said, but that's something that's more advanced that I look at in my mentorship. But if you don't want to take the full risk, don't take it. Now on the bull put spread, so bull put, we want the price to go up. Same thing. So we're trading at the 672, closed at 672. On Monday, if we open at 673, I'm in profit. If we move up by about 1% to 679, I'd be at $64 profit. And I think when we come back to the chart, either of those, either we go up by 1% or down 1%, I think either of those are likely on Monday. Which way? Who knows? But one of these I expect to be able to close in profit on Monday. And the other, we just manage and wait and see. Okay, obviously only one of them is going to be in profit on Monday. But yeah, same deal with this one. If the trade moves against us, so if we drop all the way down to 652, which is a 3% drop, we'll be on Monday at a loss of 160, right? 652, what does that look like on the chart? That's all the way down here. 652. Do I expect that to happen? Absolutely not. I mean, it's possible, anything's possible, but it's not what I expect to happen in normal trading days. You know, these are all outlier days that have those big giant moves. So it's possible, we've done it before. Actually, it's literally interesting. These 2 days that we had those massive candles, it's literally from this point we are down to that 652. So as you can see, it's possible, right? But then what did we do on the days following that? We had a bounce up. So I'm not worried about that, right? But if it happens, I'd be at a negative 160. I can either keep the trade open and close it when we hit my sold put of 646. Depending on when that is, I'd be risking 200 and somewhere between 250 and like $100, right? Or I can just simply wait it out for a bit. If I wanted to roll it, I could, but I have the choice. That's the part that I can't say enough. I get to choose how much I lose. I don't have to lose $1,000, right? If I was waking up, for me to lose $1,000 on this trade, by the end of next week, we'd have to be a 10% drop from where we are now without me exiting along the way. And you can always exit on something like SPY. You can always exit along the way, right? The likelihood that we gap below, so the only time that you couldn't exit is if you gap down to below your bought put. It's the only time you'd be exiting at max loss. And that's all the way down here, 636. Now, I don't like to say impossible because anything's possible. That I don't think is likely to happen, right? So play the odds in your favor. Play the odds in your favor. Choose your own risk. Choose when you want to exit. Choose how much you want to take a loss for. But the important part is you get to choose, right? You're not risking $1,000 if you choose not to risk $1,000. Choose to risk $200. Some people choose to risk what their credit is, right? So if your net credit is 108, you are at negative 216. That's your trigger of I'm out. But you get to choose it. And as long as the losses that you're taking are small and not max risk, because these trades have such high likelihood of profit, especially when you're placing them on the right days, right? On these days, we're placing our call. On these days down here, we're placing our put. As long as we're doing that, we're keeping the percentages of winning and losing in our favor. So I hope you find this video helpful, and I hope it also takes a bit of that stigma away from credit spreads with the you're risking 1,000 to make 100, because no, you're not. The likelihood of profit is very, very high, and you get to choose how much you lose and when you lose. One final thing to wrap this up is I think a lot of traders don't take enough losses. And I think that if you can start to take small losses, number one, it takes the power away from the loss, right? You no longer fear the loss because you don't even notice it missing from your account. You know, you don't notice that you've just gone down $200, but you notice that you've gone down 1,000. And I think that if we can just take more small losses along the way, then number one, we know that a loss doesn't hurt us, right? It kind of makes no difference. And because we're doing that, we're not risking the big loss. And it's the big loss that hurts. And I think that from a psychology point of view and a mindset point of view, that's why people lose in trading, because they associate loss with mega loss. And in doing that, all they're doing is inviting in the mega losses. And the more you do that, the more arrive, right? Whereas if you're like, oh, it's just a numbers game. We take a little loss, we get a win. We take a little loss, we get a win and a win and a win and a win and a win. Then you avoid the mega losses. So anyway, that's my little mindset rant for the day. Go ahead and take a loss if you need to take a loss. The mindset stuff I find fascinating. I love it. Money mindset, trader psychology, all of that sort of stuff is also what I cover in the mentorship. So if you feel like maybe that's something that you're struggling with is the mindset part, you're saying things like, I always lose, it always happens to me. Whenever I get in a trade, it goes against me. If you find yourself taking the losers, not taking the winners, all of that, it's just in your head. And I cover it all in mentorship. So you're welcome to check it out and come join me if you feel like you could use a bit of a help in that respect as well.